Let's talk about making the most of your HSA. It's no secret that health savings accounts are an excellent retirement vehicle. They allow tax-free contributions, growth, and withdrawals. They're completely owned by you, and they can be transferred from one employer to the next. HSA funds can roll over from year to year, and you can withdraw from them for no medical expenses by age 65 with no penalty. There's also an HSA catch-up contribution of $1,000 if you're 55 or older, just like an IRA. However, the annual contribution limits for HSAs are higher than those for IRAs. So how can you take complete advantage of these benefits? Very simple. Maximize your yearly HSA contributions and leave the funds untouched for as long as possible. And above all, invest. We've got the tools right there in your portal. HSA members can contribute up to the annual maximum amount that is set by the IRS. The maximum is over $3,800 for single coverage and over $7,700 for family coverage, but check the internet for this year's contribution maximums. So be sure to contribute these maximum amounts to your HSA each year, or as close to them as you can afford. Even if you can't afford the maximums, it's important that you contribute every year. And if you're married, split your HSA into 2 accounts. You'll still be limited to that maximum annual family contribution, but each spouse could make an annual $1,000 catch-up contribution once they reach age 55. If you haven't started maximizing your HSA, it's not too late. You can start contributing at age 50 and still build quite a little nest egg because those are your peak earning years. Now, be aware that enrolling in Medicare makes it so that you can't contribute to your HSA anymore. Anyway, side note. Let's discuss leaving the funds untouched. It's tempting, but an HSA is a great safety net for unforeseen medical expenses. That being said, if you can avoid dipping into your HSA funds and pay for your medical expenses out of pocket instead, you're on your way to building a steady retirement fund. There's no rule that says you must pay for medical expenses directly from your HSA. You can hold on to your receipts for years or decades before reimbursing yourself from your HSA, and if you can pay for your medical expenses from your regular bank account, that gives your investments in your HSA more time to grow tax-free. Ideally, an HSA holder would wait until retirement to withdraw funds, and that's when withdrawal is most advantageous because the funds can be used on non-medical expenses. Let's briefly look at investing. An HSA's ability to grow tax-free should certainly be taken advantage of. HSA funds don't incur taxes on interest or gains, so you can invest your HSA savings in mutual funds, stocks, or bonds to gain tax-free wealth. Now, of course, it's always wise to set aside some funds for short-term, unanticipated healthcare costs. Look, investing your HSA not only produces rapid growth, but better growth. When your money sits in a bank account, you may receive 1 or 2% interest, but when you utilize the investment funds that, for example, Motivhealth grants access to, your savings can grow exponentially. View Motivhealth investment options on the portal. There's a link. The average couple retiring today needs $280,000 to cover the cost of healthcare throughout their retirement. This number's startling, but if you'll start contributing the maximum yearly limits to your HSA and leave those HSA funds relatively untouched and invest those funds, the number above is so much less and less frightening. So ask yourself, are you making the most of your HSA? Start today.